let's be honest, most of us do not have the time to learn on how to pick the stocks individually. And even if we do, we would rather find a mutual fund with a professional manager that would do it for us because we trust professionals, right? But when the fund manager passes the data sheet, what does the numbers really mean? Specifically, what are the expenses involved in a mutual fund? Well, in this video, I'll help you understand what are the mutual fund expenses, what do they mean, and I'll provide some examples. And let's start by talking about the three main fees that you may want to look out for. So in a mutual fund, one of the first things that you want to look out for is something called a sales charge. Imagine this is basically the buy-in fee to get into the club. It is the one-time fee charged based on your initial investment. This fee is also known as load, or front-end load, basically is the buy-in fee. The back-end load is basically the fee that you may have to pay to leave the fund. Of course, some fund may not require the sales charge at all, and usually they'll indicate that as either no sales charge or no load. On average, it is about 3%. And this 3% is calculated based on your initial investment. So let's say if you invest $1,000, then the 3% means you have to pay $30 upfront. Honestly, you may want to avoid funds with any sales charge because it is quite common to find a fund with no load. It doesn't mean that it is bad because there may be a fund that's doing really, really well and they may be charging a sales charge upfront versus some fund might not be doing that well, so they charge nothing. But what happens if you find a fund that's charging more than 3%? Well, in my experience or opinion, you should probably turn around and run, but that's up to you. And the second thing that I want to talk about is the expense ratio. This is perhaps one of the most important fee. It is a recurring annual expense, and it means this is the fee that you have to pay for having a manager managing your fund, or the trading cost, as well as the administrative fees. On average, it is about 1% across different funds. And the reason why this is so important is because it is paid on an annual basis and it is based on your amount that you have at the end of the year. 1 to 2% may not seem like a lot, especially if you're investing maybe not a big amount. However, if you're investing for several years to decades, it could drastically reduce your return. And usually we're buying a mutual fund in our tax-free saving account or the RSP account. And that means we're gonna be keeping it for a long time. So that 1 to 2% is compounded, meaning that even though it's 1% or 2% per year, over 30 years, you will actually be losing 20% or 30% of your return. And the third one I want to talk about is something called redemption fee. Redemption fee is what you have to pay to get your money back or sell your fund before a certain time frame. This means that if you're buying a fund, they may put for example, a 30-day period where you cannot redeem it early. Or if you do, you have to pay this fee. And this is to discourage any frequent trading of funds because, of course, mutual funds, they are meant for long term. And it is harder for the mutual fund itself or the managers if a lot of people are actively trading it. Okay, let's go through some examples. I'll be going through 2 Canadian mutual funds and one US based. And the first one is TD. It is a bank, and like many banks, it has mutual funds as well that's available for purchase. I am nowhere encouraging anyone to purchase any of these funds. In fact, some of them may not even be good. But I am using them as an example because they are a little bit different and it showcases the expenses that we just talked about. The first one is a portfolio that's called a dividend growth fund. Usually this means that it is for longer term, but in this case, we want to focus on the expenses first. We talk about sales charge. Again, it is called load. So in this case, when they say it is no load, it means that there is no sales charge that you have to pay to get into the series. In fact, all three of them that I found do not have any sales charge, which is great. The second one is the operating expense or the fund expense, and they may call it the expense ratio, whatever it is basically the amount that you have to pay on an annual basis, right, to keep having this fund being managed. And in this case, for the TD one, we can see that the fund expense, the total amount is 2.04. It is split across two. The first one is the managing expense ratio, which is, I guess, what we pay for the manager. The second one is the trading cost. So every time you make a trade, there is an amount that you have to pay to the brokers. And because TD is a bank and they have their own brokerage, I believe, that's why this is actually quite small. But in total, 2.04 is very large, right? And we can look at if there's any other fees, right? So there is a short-term trading fee. Short-term trading fee is what we talked about, the redemption fee. So it's up to 2% of the purchase cost if you redeem them within 7 days of purchasing. Sometimes other funds may have other miscellaneous fees, and you also want to watch out for those. But in this case, for this mutual fund, there's only 3. But besides the expenses, we also kind of want to look at, on a very, very high level, what are the average returns. After all, the expense may be justified if they actually return a pretty good return. So in this case, it says the average return over the past 10 years is 9.04%. So this means that if you invested $1,000, they give an example, 10 years ago, then that means now you would have $2,450. Okay, so in some of my other videos, I may have talked about what is a decent average return for an index fund or a mutual fund, right? But in this case, we can compare it with S&P 500, which is a classic index fund. Index fund again has a very, very low expense ratio, nearly 0. And if you don't know what's the difference, I will put a link up for the other video that I compare between mutual fund and index fund and ETFs. Let's look at the second one compared to that. Second one is Sun Life, again another Canadian mutual fund. And let's first look at how much they charge us. The first sales charge, again, I mentioned they do not charge anything, which is great. So there is no upfront charge to get into this mutual fund. The second is the fund expenses. So again, the reoccurring annual expense. It is in total 1.08%. Compared to the previous one, this is almost half. The first one was 2 point something, right? And if we break it down, we see that the amount paid to the manager is 1.05. They have a slightly higher trading cost, but this does not really matter to us. For a mutual fund, we mostly just care about the total fund expenses. So it is very important that we see, first of all, that this is so much lower. 1% reoccurring annual cost compounded over 30 years is a big amount. The fact that this is much smaller is already a good indication. But we also want to see the other fees. We can see that this mutual fund has a lot of different miscellaneous fees. First of all, we see the second one is a short-term or excessive trading fee. Again, this is like the redemption fee. And we can see that it is 30 days of purchase. If you sell it within 30 days, then you have to pay a 2% fee. There's also a large redemption penalty. So if you are a large investor, in this case it looks like it's 5 million or more, then you may have to pay a 5% fee you have to pay a 1% fee. So this just goes to show that you probably want to look at all the other fees. Some of them may not be applicable to you at all, but different funds would have perhaps miscellaneous fees that you have to pay attention to. Again, I think with a quick look, all of these other fees does not really matter too much for us. I don't think I'll be having that much money to put into mutual fund, or I will be redeeming it in early notice. So in this case, it's really just the reoccurring fund expenses that I have to worry about. That means let's look at what is the average return. So for this fund, as of 2022 April 30th, the average return for the past 10 years is actually 13.5%. This is much, much bigger than the previous fund, right? And because they have a lower expense ratio, or the fund expenses they call it, this, I guess, could be a better choice than the first one. Let's look at the third one. Third one is from Vanguard. It is also a dividend growth fund. Vanguard is a very popular and very well-known company for managing funds. And this one I just picked randomly, but let's look at what's the sales charge and all the other expenses. So first of all, for the fees and expenses, they say that the sales charge, also known as load, is none on purchase or on reinvested dividends, meaning that any money that was returned from this investment that's reinvested into it, there's no fee for any of this, which is great. It does look like there is a service fee per year if you do not have an investment greater than $10,000, which is $20, and 20 of $10,000 is 0.2%, right? So, okay, that's something to take note of. And then let's look at the fund expenses, the expense ratio. So the total expense ratio is 0.27%. This is so much lower than the first two. And even if you have a account that has less than $10,000, that will be around 0.5% total, because they have to pay the $20 fee. And we calculate this at 0.2%. And that's not too bad. And it doesn't look like there's any other miscellaneous fees. So let's look at what is the average return for this one. Now we also want to look at what's the average return for this one. So across the 10-year period, the average return after taxes and distribution is about 12%. And this is not too bad either. But overall, I just wanted to provide a high-level overview of the expenses. And in the future, we can also dive into how to determine whether if a mutual fund is good or not. But in this case, you definitely want to look at both. You want to look at what is the average return. And usually you want to look at a time horizon that's closer to what you need. So if you're a long-term investor, you want to look at as long-term as possible. And generally, when you're investing in mutual fund, you do want to look at long-term horizons. If it's short-term, it is the data itself may not be accurate or representative of what's going to happen in the future anyways. So I encourage everyone to look at long-term investment instead of short-term investment for mutual fund. And of course, you want to compare this with the expense ratio to determine whether if this mutual fund is perhaps a good choice. I hope this video has helped you, and if it has, please leave a like and subscribe. And thank you so much. Until next time.